everyone. Didn't mean to scare you there, John. Welcome. I just wanted to go ahead and get started because I know your time is valuable as well. I'm Commissioner Sally Clark, and I wanted to thank you for coming tonight. This is one of the many workshops that's been sponsored by El Paso County with United Policyholders, and we really appreciate the partnership that's been established in not only post-Waldo Canyon fire, but also now post-Black Forest fire. Just curious, how many of you are here that are survivors from Waldo? And then how many Black Forest? A lot of you guys. And anyone just who had flooding that wasn't affected by either of the two fires? Just a couple. I think it's important to note that we've had 3 disasters within about a 2-year period that were nationally declared, which is not a list that we want to be, but we're very grateful that we've had great support from folks like Carla Hurd-Price up there, Carrie Olivier, who I've known for many years, as well as our speaker tonight, who's going to talk about tax implications and tax policy as it relates to disasters. So we're doing a lot of things. El Paso County, as you know, has been working pretty diligently in the disaster recovery area. I'd like to also introduce R.C. Smith, who is our Waldo Canyon disaster recovery manager, and he's also working, tag teaming on the Black Forest fire as well. So always feel free to call on R.C. as well, and you can call me if you have other questions. Those of you from Black Forest, Commissioner Glenn is your county commissioner, but we all take an interest in what's going on right now. We've got mitigation going up off of Highway 24. As you might have heard, CDOT is working up there along Highway 24 to try and keep that corridor open. We're doing a lot of mitigation in the Black Forest fire area. And I just want to say, really, that my heart does go out to you. I know this has been a difficult time for those of you, no matter which fire you're a part of and have survived. We are here to help whatever way we can in terms of support. So at this point, I don't know, Carrie, is there anything you'd like to say? So I'm going to turn it over to Carrie Olivier, and then she can also introduce John Trapani, who's here tonight to talk about tax implications. Again, anytime, email me, call me, and if there's a question that you have that you don't know who can answer it, I'm happy to try and get those answers for you. So thanks for coming tonight.
Thank you, Sally. Hi, everybody. Thank you for coming. And first of all, I want to thank a few people, too. And I really want to thank our Commissioner, Sally Clark, and R.C., and the county folks in general, including Nancy. I mean, these folks are working just extraordinary hours to try to get it all done for us. And in D.C., lobbying all over the place to get funds and to try to keep flood insurance available for us at a reasonable rate. There's all kinds of stuff going on behind the scenes that these folks are doing for us. So I wanted to be sure to thank them. Most of you, how many of you have not been to a United Policyholders recovery meeting? Well, welcome. I'm going to go through this pretty quick. This is just a little bit about who we are so you can understand who's helping bring you this information. United Policyholders is a not-for-profit organization that is a consumer advocacy for insurance matters in all 50 states. We've been in existence for about 22 years. And I learned an interesting fact about our speaker this week as we were doing workshops along the Front Range for the flooding. John Trapani actually had his home impacted severely in the 1994 earthquake in California, and that's how he came to get involved in this particular area of expertise, and was at the time looking for answers and found some answers through what was a very brand new baby organization of United Policyholders. And he's now back volunteering to bring information to you guys. So, you know, we are funded by donations and grants only, not for profit, not for sale. You're not going to find out someday that the insurance companies funded anything to do with this. So this information is brought to you. We don't endorse the information. We don't endorse the speakers. In other words, we're not recommending that you hire our speakers. We're just finding people who have expertise, who are highly recommended to bring you good information to consider in your recovery. So we have the Roadmap to Recovery program, which we're doing right now. We also have Roadmap to Preparedness, which we hope to be able to continue to bring you on making sure that you're buying the right insurance going forward. And then Advocacy and Action. One of the things that the folks that had experienced the Black Forest Fire and issues since have to thank for this kind of advocacy is that the law was changed in May of the year following Waldo to allow you to have 3 years. It's a statute that you have 3 years to go and do action against your insurance company if you feel you haven't gotten a satisfactory outcome and you have an action potentially against them. We're not recommending you do that necessarily, but it's good to know that you have time to work through your claim through the full time that is allowed in the policy before you make that type of decision. So that's who we are. These are some of the places that we've worked and gone into and helped, including Sandy and High Park, Texas, all over California. And I hope most of you know that we have a lot of resources on the website. How many of you go to the website, UP, for resources? Great. I want to encourage you to do that. Shortly after this event, we will have this up on the website in video form, thanks to Nancy and the county. And Mr. Trapani has been so kind to provide some amazing handouts and resources, some of which we'll have up on the website by PDF that you can download also. And then he's going to give you some links to his website for a special document at the end. So you can go on our Ask an Expert forum. You go online, www.uphelp.org. Your name stays private. You can put questions out there that have to do with insurance or disaster recovery matters, and anonymously, one of our experts will answer your question. We're just here for educational purposes. We're not your formal legal advice, but we hope that you will glean some good information from all of this. It's a lot to soak in tonight, but you'll have time, and the good news is that you'll get a heads up on some things you might not have had before the filing deadline for this year. So I want to introduce John Trapani, and he is going to take you through kind of an intense lesson here tonight, and we so appreciate him volunteering his time to be here. Thank you, John.
You're welcome. Ooh, good evening. Escape.
Oops.
No, help you. X out.
I was jumping right to F5.
There we go. F5. There we go. Okay.
And there will be time for questions at the end, so as much as you can bear it, try to hold your questions, and it'll help us get through the information. Thank you.
Good evening. Yes, I'm John Trapani, and our topic tonight is the disaster recovery aspect, or the tax aspects of the disaster recovery process, including tax benefits and tax reporting responsibilities. We're going to be covering a lot of information, but I want to focus on 3 major questions that I will be answering as the evening goes along, and some of these questions get interweaved in several places. So I want to highlight them at the beginning. The first one is, do you have a loss or a gain? And for tax purposes, it is possible to have a gain. It's not another disaster to have a gain, but it is possible to have a gain, and we'll talk about what to do with that. The second is, if you have a loss and it's a deductible loss, there's an issue as to what year do you take the deduction, and we'll talk about that. The third is, some of you may be considering selling the original property, the property that was damaged, selling the lot and buying someplace else. I think there's been some meetings on that already in terms of the financial side, all that kind of stuff. I'm going to spend a little bit of some time dealing with the tax implications of making that decision. There have been a lot of people that have made this week possible. I don't know how many emails I've gotten over the last month and a half just trying to make arrangements and stuff, and I've been really impressed with not only the cooperation, but the camaraderie, the collegialness of the people in 3 different counties getting together to make this all happen. And there's a list of the local people, the Waldo Fire volunteers, including Carrie Olivier and others, and of course, a strong force coordinating the whole thing, United Policyholders. This is the small print portion of my presentation. The IRS specifies that in order for you to be able to rely on tax advice when a controversy arises, that tax advice must be in writing, must be addressed to you, and must deal with specific facts that are addressed in the written matter. So, unfortunately, none of those 3 things we're going to have tonight. So this is educational. If you do get into a controversy, I'm happy to help you. Hopefully, we'll keep you out of controversies. There's some material that's been passed out to you already, and there's a little bit change in terms of how I got it on the screen here and how we organized it this afternoon at FedEx. So the top piece is a summary outline of the material that I could be presenting tonight. If I presented all that material, we would be here until after midnight, okay? So there's only a portion of that. I think most of the ones that are checked off at the left of the item, we'll be dealing with those. The second piece, well, not the back of that page, because we'll get to that in a second, but there's another piece of paper that's 2-sided that's notes, and it has a table at the bottom. That table I will be getting to later, but I want you to have that format to take home, and you'll see why. On the back of that, there's a place to write down 3 questions. Maybe you have 4 questions, maybe you can write them in. But the idea here is not to hand the questions in, but just as the question arises in your mind, jot it down, and then we get to the question portion of the presentation, then you'll still have it fresh. By the time we get there, maybe the question's gotten answered, but at least you don't feel like, oh, what was that question? And then then there's the back of the first page, which in your version is 2 copies. That doesn't mean it's twice as important. Just originally it was a half sheet, and when we printed it today, we just printed it on the back of the first sheet. But this is important information for today, and I'll be discussing all of this as we go along. But because of its importance, I wanted you to have something that you can take home and read over and over, and you'll understand why I feel that it's important enough to do that. Then, what you don't have in your hand so far, one is a green piece of paper that's available up at the entrance that is basically a kind of a form, a memo from you to me if you would like me to contact you next week and it asks you for some statistical information so that if you do, when I call you up next week, if you turn it in, I will have a little bit of background to start with, that we can start the discussion. The other thing is, at the end of the meeting, that outline that you've got, that summary outline, is expanded into a much more detailed outline. And the reason I didn't pass it out ahead of time is I don't want you spending the next 2 hours reading it. So I want your attention up here. So that's where we are. As Carrie said, my house was severely damaged in the Northridge earthquake on January 17th, 1994, 4:30 and 55 seconds to be precise, a 6.7 earthquake. The epicenter was about 1.5 miles from my home. A lot of neighbors I helped a lot of clients. I got new clients as a result of it. And because of the fact that I got into this and I have this compulsive need to understand something, and especially since my house was at issue, so it was personal, it was important to me to understand in detail. And in fact, about a month after the earthquake, actually it was a couple of weeks, there was a newsletter that came that would describe disaster losses, which I thought they were really on top of it, but there had been major fires in the previous October, and I realized that's why the article got written. But in the article, they were describing my house, which had some unique characteristics. And I read through it, and I said, man, this is great. I'm not going to have to pay taxes for 5-6 years because of this, what they're talking in here. And then I read it again, I said, they were wrong. I called up the publisher, and I talked to him, and he kind of, well, yeah, maybe this. And anyway, a couple of months later, he sent me a draft of an article that was going to appear in the May newsletter. It says, is this one okay? And I read it, I said, okay, now you got it right. So even, there's a lot of places, and I think things have gotten better in some areas, but there's been a lot of new regulations, new laws and stuff that have come out that actually make it more complicated and make it more difficult. And I've made it my job to try to stay up on this stuff. I've written a 500-page textbook that I use to teach accountants, with another version of these slides tonight that we'll be doing about a third of them. The full deck is about a 4-hour presentation that I could do for tax professionals. Okay. As I talk tonight, when I use the word disaster, let me specify that that has a specific meaning. Now, let's say, forget Black Forest fire, that simply your house, and only your house burned down and your whole area was the only, you had a kitchen fire and somehow it got out of hand. That is a personal disaster, okay? I want to specify that I acknowledge that, and I wouldn't argue with you to say that that's a personal disaster. But for purposes of tonight's meeting, my discussion, that's not the kind of disaster I'm talking about. The only disasters I'm talking about, when I use the word disaster, is ones that are on the FEMA website, fema.gov/disasters. And for Colorado, these are the only 4 designated disasters for the last 2 years, okay? And I guess I need to, there will be time for questions at the end, and we've been doing it a couple of different ways and found out that it's really better to wait till the end, because the first night when we didn't, half the questions that came up were, I said, I'm going to be talking about that in 3 minutes, or we'll get to that in 5 minutes, which took a lot of time. So we're going to hold off the questions until the end. The IRS, what's their job? Their job is to administer the tax laws, and Congress enacts or passes tax laws. The president signs them and enact them into law. And the primary purpose of these tax laws is to raise taxes to run the government, right? So they can pay their bills. So, but it turns out that there are some areas of the tax code that I refer to as tax law empathy, where the tax law acknowledges that there are some times where the tax law, without these special code sections, the tax law would get into your life in a way that is not what Congress, government really wants. And the two major ones that we're going to be talking about actually go back to the original tax law that was enacted after the 16th Amendment was passed in 1913. So we're talking about stuff that's happened over 100 years, and these code sections and then additional code sections that have also been enacted actually over the years have gotten better and better. Any additional expansion of them has only increased their tax law empathy. So, but there is one thing to be aware of, and this is very important, and this goes back to that piece of most important today, that's one aspect of this, is that before you can claim any kind of loss on a tax return, you have to fully prosecute, so to speak, fully make your claim against your insurance company or anybody else that may have responsibility for your loss. The tax law is not a replacement for making a claim against somebody who is responsible for your loss. The other thing I got with regard to disasters, most of what I'm going to be talking about until I get to the very end, then I'm going to have a big thing that says federal disasters. Most of what I'm talking about will apply, and I think everybody's Black Forest, most of Black Forest or Waldo Canyon, both of which are federal disasters, but in case there's somebody that is some other event that is not, most of what I will be talking about is applicable to all casualty losses, all involuntary conversions, which I'll define that in a minute. But there'll be a couple of times during that I will specify, okay, this is for disasters, and then there'll be a whole section at the end where I'll get into disasters. So the two main code sections are 165, which deals with casualty, losses, and gains. But once you get into the gain situation, you're probably then going to say, okay, now I want to use code section 1033, which deals with involuntary conversions. What the heck is that? Okay. An involuntary conversion is basically a situation where you have insurance, is an example, where something has happened that you didn't wake up in the morning and say, well, I think this would be a good day to have a fire. I don't think that happened. So that was something that was forced on you, right? And so you had your house, there was a fire, and then you made a claim with your insurance company, and hopefully you got a bucket full of money, okay? I know. But theoretically you should, okay? And as a result of getting that bucket full of money, the amount that you got at that moment in time, and we're going to be doing this in little increments, at that moment in time, turns out to be greater than what you paid for the property originally. Because of that, for tax purposes, you have a gain. Because it's an involuntary conversion into money, you get to take that money and invest it back into the same kind of property, and if you spend the money doing that, reinvesting, then there's no tax implications, but there's a lot of reporting, and we'll talk about that. Okay. Does anybody think that their situation is the same as their neighbors? I don't think so. Hopefully not. I was talking to somebody earlier tonight. I made a list about 6, 7 years ago of how you could be talking to your neighbor, and I could point out 25 different ways that your situation is different from your neighbor's situation. And we know, like with the lottery, there's 53 numbers and you got different possibilities, and that comes out to, I don't know, trillions of different combinations. Well, take 25, it's maybe not trillions, but it's a pretty big number. At least it's possible that each and every person in this room has a totally unique situation. So keeping that in mind, I will not be able to, I have to stay pretty general, okay? I will try to cover various possibilities, but I probably am not going to cover your exact situation. But hopefully you'll be able to convert it for your benefit, or to benefit you. So it turns out also that the IRS, talked about losses, I've talked about involuntary conversions, but the IRS only has one form, and that's the 4684, and it deals 99% with losses. There's a little piece that actually does deal with gains, but it's a portion that most people will not use that piece. So since that's the form that the government has, that's where we'll start. This is a sample of a 4684. There's 2 pages to it. We're going to be dealing with page 1, which deals with personal losses. Page 2 deals with investment property and commercial property, business losses, and how that form works. In some ways it's very similar, but it also has very different implications and results. But we're not going to talk about, we're staying with personal tonight. Now, there are 3 general areas of the form. The top is line A, B, C, and D, okay? And it could have been numbered 1, 2, 3, W, X, Y, Z, anything. So, because I'm going to use A, B, C, and D later, and this A, B, C, and D has nothing to do with the A, B, C that I'm talking about later. I want to make that clear because it was a little confusion a couple of nights ago. So, this is where you would categorize or describe the category of items that you've lost. There are 4 columns below which correspond to those items. And if you have categories more than 4, and it's very possible that you could have 4, then there's more pages that get added. And most of you are using software, so it works. The software knows how to add pages. At the bottom, which I just blanked out, there's basically some adjustments, and I call that just math, and we'll talk about that later. Okay, takes up a lot of area on the form, but it's simple stuff. So we're going to concentrate on those columns, and we're going to look at one column. So looking at this one column, there are 8 boxes on there, but there's only 4 pieces of information. Again, the rest of the other 4 boxes are just math. So it's really not that imposing, but how we get to get those numbers in there, that's the imposing part. So the top one, the first amount is cost basis. And each of these we're going to talk a lot about. I'm going to talk a lot about. The first one is cost basis. In summary, it's what you paid for the asset. So let's just take a simple concept that applies to probably everybody, and let's say it's a car, okay? And let's say in the fire, your car was destroyed. So you paid $30,000, let's say, for that car. And remember, the minute you drove that car off the lot, everybody knows it's no longer worth $30,000, okay? So we'll get to that piece, but the $30,000, what you paid for it, is cost basis. The second line is insurance. And insurance actually could be more than just insurance. We'll get to that. But it's what you were compensated for that loss for that particular item. So the items get categorized somewhat based upon the insurance categories. Then there's this what is the most difficult part of the thing to deal with in many cases, and that's the value of the property before and after the loss. So let's go into the next thing where I'm going to have 4 different scenarios, starting off with that numbers and rounded on the first page, on the first slide there, and then making some modifications to see how the results differs. So we've got cost basis paid, and this is generic. You can imagine whatever asset you want. It could be personal property, it could be a car, maybe it's not a $176,000 car, or it could be a house. however you want to envision it in your mind, for this purpose, it doesn't matter. But I've got a cost basis of $176,000. In this case, the taxpayer had $30,000 of insurance, very underinsured, right? Now, at first blush, what we'd like to do is say, oh, you know what, I did a mistake here. At first blush, what we'd like to do is say, God, $176,000 of cost, $30,000 of insurance, you got a $146,000 loss. Well, remember that car, when you drove it off the lot, and let's look a year down the line, and you sell that car for $20,000, you don't get to take a deduction for that $10,000 loss. That's considered a personal loss. And when you've had a casualty, a disaster loss, a casualty loss, you can't convert that segment of your depreciation into a tax deduction. So that gets us into the bottom section. The bottom section, which is the value of the asset just before, and this is like a nanosecond apart, theoretically, the value of the property just before the loss event and the value of the property just after. So in this case, these assets, or this asset or assets, were totally lost, totally destroyed. So the value, the depreciated personal value of these assets was $130,000 before and $0 after. So that's what I refer to as our economic loss, okay? So the economic loss compared to the 176, we're stuck with $130,000 loss. From that 130, we deduct the $30,000 of insurance proceeds and we come up with $100,000 loss for this column, okay? Second column, I've increased the insurance proceeds to $150,000. So in this case, the $150,000 is greater than our economic loss, so we don't have a tax deduction. But because the $150,000 is less than the cost basis of $176,000, we also don't have a gain. It's a net zero transaction for tax purposes. Third possibility. Now we've got some assets that actually appreciate. Might be something like a piece of artwork or antiques, things that actually, personal things, or it might be a house, okay? Anything that has the potential of going up in value. So I've got value before of $300,000, and in this case, maybe it's the land, maybe it's salvage value. It has a value after the loss of still $120,000. So my economic loss is $180,000. Well, since $180,000 is greater than my cost basis of $176,000, I am limited to the $176,000. I can never deduct a loss greater than the cost basis. So that's where cost basis is kind of my upper limit of my deduction. So I've got $176,000 less the $150,000 insurance proceeds. I've got a $26,000 loss in this column. Last column, I've got $200,000 of insurance proceeds. I don't care what the economic value of the property is. I have a gain. In this case, I've got a $24,000 gain. I've got to deal with it, okay? If I allow that $24,000 to go on that next line, it will end up through various ways through the tax return on page 1 of your tax return as a capital gain, just like if you sold stock and had a gain on the sale of the stock. So it gets generally speaking, gets taxed at long-term, favorable long-term capital gains rates. But there's another way, and that's the invoking the involuntary conversion rules, and we just wouldn't use the 4684 at all if that was the case. Now, there may be some cases where we do actually use the 4684, and I'll talk about that. So, now that we got the basics down, and that's probably 40–60% of what I'm going to talk about tonight, okay? Now we're going to get into the weeds, so to speak, and we're going to talk about the documentation for all of this. So first one is, let's go back and start at the top, cost basis. We've got different kinds of assets. Real property. Real property is different than stuff inside the house, okay? Real property, I've got a line in there that says ag property. The reason, and I'm not going to cover anything, but I just want to acknowledge that ag property can get very complex because it can be a combination of real property, business assets, personal assets, and in order not to confuse too many people, I'm sticking with basically personal assets for tonight. So, real property. Let's talk about real property for a second. How do we find out what is our cost basis for real property? It's what you paid for it. Maybe you've made some improvements. Those improvements count also. How do we document that? So let's take the extreme case. The fire all of a sudden hit, and you grabbed some photographs, you grabbed some other valuable personal items, and you ran like crazy, right? Did you get your documents related to the cost basis of your house? Maybe not. Maybe you put those in a safe deposit box, then you still got them, but they're gone, let's say, okay? So what do? Well, there's various ways that you can go about getting information, okay? Probably have a loan on the property. So when you got the loan, the lender asked for your sales, got information on how much you paid for it so that they didn't loan you too much money. So they probably have some documents. You've probably, in most cases, used a real estate agent, a real estate broker firm. They probably may still have records. Of course, if you bought the house 20 years ago and that brokerage firm has gone out of business, probably out of luck there, but you might check if you can remember, and this is probably the last person that you would remember generally, if there was an independent escrow company that handled the transaction, they may still have some documentation. Title insurance on the house, the title insurance company might have some information. Last resort, and I don't mean this in an unkind way, but just maybe the most difficult way to do it, would be to go into the county records, the assessor's office, and see what kind of history they have. I don't know in El Paso County how that is there, but that might be a way of doing that. Now, you add a room on, or you remodeled the kitchen, an improvement. By the way, if you put a rose bush in, that's an improvement. If you put in petunias, that's not an improvement, that's maintenance, okay? Because rose bushes last a long time, petunias last for a season. So, you put in petunias once a year for 20 years. No, that's not 20 times the cost of petunias. Again, if you used a contractor to do the remodeling, you can maybe go back to the contractor and get that. The other thing is pictures, and maybe pictures of the house or people in the house with the background of a room or some addition or something may be useful, okay? Many years ago, I had an audit of a taxpayer, a client who had bought their house for $38,000 and then over 18 years improved it with another $330,000. And they sold the house in a taxable transaction, and the IRS came out and spent 3 weeks in my office going through every little piece of paper that we could find to come up with the cost basis. One of the things that happened is we didn't have any documentation for a jacuzzi in the backyard. But we did have pictures showing his kids this tall playing in the backyard, and another picture showing his kids, this tall, sitting with Dad in the jacuzzi. And the agent says, well, it looks like you didn't have a jacuzzi and you put one in. The amount that you told me that the jacuzzi cost, I buy that. That's reasonable. So I had a reasonable guy, and I had something other than a piece of paper that had a dollar number on it. There were some other things that he said, geez, I'd like to accept it. I'm not saying that your client didn't spend the money. It's just that given the circumstances of this particular item, I can't say that it must have been done. So there were a couple of smaller items that we lost. But we probably got 95, 98% of the cost basis. I thought it was pretty good. Personal property contents. What is this? Well, this is stuff inside the house that's not nailed down. Okay? So this rug is not personal property. But if there's a picture on the wall, whether or not it's really tied down tight to the wall or not, just for safety purposes, that's personal property. Your couches, your coffee tables, all your linens, your clothes, jewelry, go on, and we'll go on and on later. But all that stuff, and this is the toughest category, group of assets, because I think of my own kitchen as an example. How many of those cooking utensils do I have in that drawer? I got some out on top, and I got some in the drawer, and that's just one drawer, okay? So you need to do a reasonable job. I can guarantee you're not going to inventory, unless all along you've been inventorying everything when you go to the store and you buy a spatula and you wrote it down someplace. But generally speaking, concentrate on the big stuff. When it comes to that drawer full of spatulas and whisks and stuff, whatever else is in there, spatula, whatever, spoons, cooking spoons, you think, well, God, there's probably 20 in there. Maybe there's really 22. Maybe there's only 19. There's 20 in there, and I bought them over some period of time. Maybe on average I paid $3. So we're talking about $60 for the drawer, right? Okay, this isn't going to make or break your stuff, and it's not worth spending a whole lot of time on it. But things like the couch or an expensive coffee table. I think I paid as much for the coffee table. My girlfriend told me, you got to have that coffee table. It was my money she's spending. The coffee table is more expensive than the couch, but that's another story. I still love her. There's another category that is personal property, but it has a special meaning and a special differential, not because of how you own it, but how it's identified in your insurance policy. Let's say that to the husbands in the crowd, you were real generous when you got married, and you bought your fiancée at the time a diamond ring, and you spent $3,000 for that diamond ring. And a lot of times they'll give you, part of the purchase, you'll get an appraisal by a registered gemologist. And a lot of times that appraisal, and I'm using real facts from somebody that I know, they paid $3,000 for the ring, and they got an appraisal that was a solid appraisal, wasn't phony, that said it was worth $6,000. They took that appraisal, not the cost, not the $3,000, just the appraisal, to their insurance agent and said, we want to insure this ring so that in case it meets some bad situation, we can get compensated for the loss. Okay? The insurance company writes a rider to the policy, and now you've got scheduled property. It could be artwork, it could be maybe an expensive antique. There's a lot of things that fall into this category. These are items that we'll have to deal with separate from the rest of the contents. The last item is what I call rolling stock. It's the vehicles, the cars, the boats, the trailers, the RVs, and all that stuff. These are one-off purchases. Again, you bought it probably from a dealer. Probably go back, get information from the dealer or the finance company. So there's some place that you can probably go. If you bought the RV 20 years ago and it's still in good condition, you kept it up, the dealer's gone out of business, it's paid off, there are other ways to go back. And first is, what do you think you remember paying for that? And that's a place to start. And then if you still got it, we'll get into the other aspects. But right now we're worried about cost basis. Okay. The next line is insurance. It sounds easy. It's like, okay, I made a claim with the insurance and I got so much dollars, okay? But every line gets complicated, I'm sorry. So some people go out and they hire a public adjuster. And the public adjuster charges for his services, his or her services. And so let's say that you've gotten a public adjuster, and for whatever category of asset, probably the structure of the house, you're looking, the public adjuster negotiated for you and got $500,000 and charged 10% for that. So net in your hands is $450,000. The amount that goes on this line for that transaction is $450,000. The public adjuster's fees are netted against the proceeds, okay? They're not dealt with any place else on the return. They get netted against the proceeds. On my blog, this is probably one of the biggest questions that comes in. How do we deduct public adjuster's fees? You don't deduct them. They're a credit, or they're a reduction of the insurance proceeds. In a way they are, well, I don't want to confuse you. Okay, but now, grants. There's all kinds of grants that you might get. FEMA has several different kinds of grants, okay? And I'm going to jump back to my experience with FEMA with the earthquake. A couple of weeks after the earthquake, everybody on our block got a check in the mail for $2,300 from FEMA. Free money. Basically, for what? Basically to help with additional living expenses, okay? And so that was a free check. We didn't have to declare it. It doesn't have to be reported, no taxable income. It's not ALE, which we'll talk about later. It just was free money. Then they sent out some people that inspected our house. Now, the final scope of loss on our house was $800,000, okay, to repair it. But these two people came out from FEMA. Their objective was to provide us with enough money that we could do some minimal repairs that would allow us to shelter in place, to still live in the structure while we're going through this process, so we're not out on the street. And so after their analysis, they came up and they gave us a check for $4,500 for temporary repairs. That $4,500 was additional insurance proceeds and got added to the insurance proceeds that we got from the insurance company. Keep forgetting the next line. Lawsuits. Hopefully not now, hopefully not ever, that you have to get into a lawsuit. But there's three aspects of this. One is, what are you suing for? Okay? Well, you needed $500,000, and the insurance company only paid you $200,000, and no matter what you do, they don't want to pay you the other $300,000, and your policy is for $600,000, so there's definitely coverage there that you've paid premiums on. So what do you do? So you beat up on them as much as possible, and sometimes consistency in beating up on them does a lot of good. Maybe it solves the problem and they write you the check. Sometimes you got to hire a lawyer, okay? So the lawyer goes and sues the insurance company for $300,000. Now, because they were so nasty in the process, the attorney then adds a claim for something called bad faith, generally, okay? Now, the bad faith amount, while on one hand you're saying contractually you owe me $300,000, but because you're miserable, rotten people, you need to pay me $10 million. And of course, that gets the insurance company's attention, right? Okay? So it goes through some process, and most likely, unless they're really, really nasty, you end up settling. So let's say that in the process of settling, they write you a check not for $10,300,000, but for $1,030,000. Okay, 10% of what you were claiming. So first reaction is, oh, okay, So I got my 300,000, and then I got another 730,000. That's the way I would like to look at it, okay? Because that 730,000 is going to be taxable, okay? The 300,000 we're going to deal with like insurance proceeds. And then the attorney took, I don't know, a third and take that off. Maybe 40%, depends, whatever. But that becomes deductible from proportionately from both of those amounts. Problem is, the IRS looks at it and says, you know what? You claimed 300,000 and 10 million. You got 10% of that, so we think you got $30,000 for the property and $1 million in bad faith. Ugh, that hurts, okay? Because now you're paying taxes on a lot more money, on $270,000 more. So it's very important if you get to any close to that kind of a point, that you make sure that the attorney discusses how he writes the allegations in the complaint with an accountant who is knowledgeable, so that the complaint does not put you in a trap when you come to a settlement process, okay? Last thing, SBA loans, SBA funds, loans. Now, you notice I said SBA loans. You have a loan on your house, you have to pay that back. You borrow money from the SBA, that is not insurance. I had a question, somebody emailed me a question last week. How do I deduct the SBA loan funds that I got? I'm like, wait a minute, the SBA gave you cash and you want to deduct it. No. One, that's never going to happen. But also, the SBA, since it's a loan, it's not insurance. That's why I've got a different color on it. I think I got a different color. It's a loan. It's money you have to pay back. The interest that you're going to pay may be deductible, depending upon other situations. Now, here's the ABC, which has nothing to do with that other ABC, okay? This is looking at a typical homeowner's policy. Categories A, B, C, and D. A, structure, that's what I call the step-off value, because everything steps off, generally speaking, from there. So the structure is basically the main house, okay? Next line, B, sometimes it's called other structures. There's a word that only appears in insurance policies, appurtenant structures. What it basically is, it's that detached garage or that pergola that's built for shade out over the patio that's not attached to the house, or maybe a small guest house. These are other structures on the property that are not part of that main structure. C is the contents. D is additional living expense. These are monies that the insurance company pays you because you don't have access to living on your property, and so they support you in some manner so that you can pay for the bills of living someplace else. We'll talk about that later. The ALE has nothing to do with the 4684. It's a totally separate animal, okay? Then we've got code upgrades. They're in your policy possibly, maybe, and then that's scheduled property. Then we may also have special coverage for landscaping and maybe special coverage, additional coverage for trees. And these, again, are usually some percentage of the schedule, the structure amount. Now, I took this picture before I did this presentation in France, but I don't get to deduct the trip because I've got it in my presentation. Just want to make that clear. I didn't do that for that purpose. I just did it to show off a picture I really like. So we start off on the left side. A and B are going to get grouped together along with the code upgrades and the landscaping and the trees. All that stuff is, no matter how it's divvied up, all of that is one proceeds for real estate, okay? So one column, if we end up with a loss, one column in that 4684 probably the first one, because it's going to be the biggest one, is the real property. Okay? My home at 4684 Spruce Street. Okay? Then we've got the other thing to deal with, and that's going to be, whoops, no, yeah, we're there. C, contents, scheduled property. We're going to deal with those separately. So even though I might walk into your house and I'd see, well, there's a piece of artwork over there and another piece of artwork over there, I don't know that that was a $500 one that you bought it 20 years ago and it's still worth $500. And that one is a piece that you bought from a local artist who became famous and died, and all of a sudden his thing's worth $400,000 and you've got it insured as scheduled property. I don't know that. I'm not an art expert, okay? What I'm saying is that just because it's scheduled property doesn't necessarily looks different in your house. Okay. Now here's the easy part of all this in a sense, because now we're dealing with dollars, transactions that are happening after, and so you've got the access to all of the documentation. You want to keep copies of everything that comes in on any of those payments. You want to keep copies of the checks. Sometimes the checks are paid for 2 items, and you want to make sure that you know what those 2 items are, because they may be 2 separate categories that have to be dealt with on a tax return. The other thing is, I acknowledge that a lot of times, most cases, if you have a loan on your property, the insurance check is going to be made out jointly to you and the lender, and what's going to happen is the lender's going to say, we'll hold on to that until you show us that you're making progress on the improvements. But there's the other money that comes in. I would suggest you put that in a separate checking account so that you're able to identify, oh, this is groceries for today. We don't write the check out of that account. We write it out of the one that we got over here, because you don't want to dissipate those funds that you may have to specifically identify how you spent them. Oh, yes. Just a little comment here. That little kid in this picture is me. That's the last time I was in Colorado. My father was actually was stationed in Colorado Springs. I'm not sure if it was Peterson or Carson. He was a map maker during World War II. And I wasn't born here, but I was conceived here. And we moved, after the war, family moved to California. Okay, so we've got the basics down, so let's look at get deeper into the weeds, and we've got 3 possibilities: no loss or gain, loss, and a gain. So let's look at the possibility of no loss. Many places I'm going to use bar charts, okay? Now, for those of you who may not be familiar with the concept of a bar chart, just think of it as a stack of money. The length of the bar chart, the more the length of the bar chart, the more money it represents. The shorter it is, the less money it represents, okay? So I'm going to start out with cost basis. So this is going to flow just pretty much like our form. So we've got cost basis. I don't put any specific amounts in here. Just it's an amount, okay? Now somehow we've had a loss, and somehow we've computed the value of that loss, the amount that we're going to deduct on our tax return. Okay? That then leaves us with remaining cost basis. So let's say that this is all the information we have, and we have the funds to rebuild the house, to replace that damage. So the dollars we would spend would now create new cost basis that would get added, that would get added to the remaining cost basis, excuse me, that's why I had the second. So we would replace the original cost basis that we deducted, that we wrote off, and then any additional money that we spend would create new cost basis. So we would end up with the remaining cost basis, the replacement cost basis, and the new cost basis. that doesn't relate to whether or not we were, the stuff, it relates to the dollars, okay? So we would end up finally with basically the original cost basis plus some increment. And while I did that, I went over on the other side and I put some red over some of the yellow because that's the insurance proceeds that I got, but my insurance proceeds were less than my damage, so I've got a deduction in this case. And how that relates to the 4684, the white bar, the cost basis, is that top line. The red bar is the red portion of the bar is the second line, the insurance, and then all that yellow is needed to compute what the loss portion, the yellow that's underneath the red. But what happens if the insurance proceeds equal or exceed the cost basis? Okay? I said that wrong, I'm sorry. Equal or exceed the damage, the loss. Well, as you see, I don't have any yellow showing. I don't have a loss. So again, though, the rest of the bar, the chart looks exactly the same. It's just that the red overlapped all of the yellow. So I would have, if I was filling out a 4684 with this information, converting it into numbers, I end up with a zero gain or loss transaction. So that's our no loss or gain. So let's go into the loss. We've got a glimpse of it there. And first question that throws people, who can deduct the loss? Do you have a right to deduct the loss? Is that your loss, or is it it looks like maybe your loss, but maybe it's somebody else's loss? Use myself again as an example. I now live in a townhouse. So we've got 50 units, plus we've got a clubhouse and a pool that are technically owned. I have a 1/50th common interest in that clubhouse, but I don't own the clubhouse. The homeowners association owns the clubhouse. If it burns down and it's not replaced, true, the value of my property diminishes because people want to have a clubhouse. They never use it, but they want to have a clubhouse, okay? But I don't have a loss because my unit was not damaged, okay? There are other similar type situations. I think I was talking to somebody last night where he had a road that he had to spend money on fixing a road, but it wasn't his road. He doesn't own the road. So I don't think he may not have a deduction for that, okay? I didn't really come to a definitive answer. I got to think about that a little more and get into it a little bit more, but I don't think he has a loss, unfortunately, because he didn't own it, okay? Second one is, when do you get to deduct a loss? Again, assuming we have a loss. Two things must be present. There must be an event. Well, that's why we're all sitting here tonight. There was an event. We had a fire. Okay, so that piece is taken care of. But the other thing is that it must be what's called a closed transaction. Now, for tax purposes, what a closed transaction means is that we don't care, generally speaking. There may be some case, there's one case that this is not true, but generally speaking, we don't care about the repairs. What we care about is the compensation. Have you gotten all of the information? Doesn't necessarily mean you've gotten all the checks, but you have gotten all the information to know what those checks are what the amount of those checks are going to be, and if you have to pay public adjuster, what those fees are going to be. That is tied down and complete. This requirement, one, it's a requirement. It sounds ominous. Reality is, and we'll see this later, reality is this really is protection for you, and you'll see why that is protection as we get into this later. Okay, so now we're into the bottom section of that form, determining the loss, value before, value after. The IRS not the IRS, the Internal Revenue Code passed by Congress, signed by the President, has two ways of computing the value before and the value after. One is called the appraisal method. The other is called the cost of repairs method. Both methods are equally allowed in the Internal Revenue Code. The IRS cannot force you to use one or the other. The choice is yours, okay? The only thing is that once you choose that method, then you have to follow all of the requirements that are designated to using that method. If you don't follow all of the rules and the other method turns out to be a lower deduction, you are going to be harmed. You are going to lose in an IRS audit, okay? So you come to a conclusion as to which method you want to use, which method works for you, but you better follow the rules so that you can be safe in using that method. So let's look at the appraisal method first. And for the kinds of losses with real property that we're talking about here, generally speaking, 99.9% of the time, I would say this is the preferred method. In reality, this is the easiest method. It's also going to cost you some money because you're going to have to hire an appraiser. We'll talk about that in a second. So the appraiser is going to value the property immediately before and immediately after the event, okay? Now, the house is gone. How is he going to appraise a house that's no longer there? So this falls into the category of being what's called a hypothetical valuation, okay? So the question is, how much information can you provide the appraiser as to what was there before the fire? Do you have pictures? Are there a set of plans? Maybe at the county, the building department has may still have a set of plans. That might be helpful. There's all kinds of stuff, and maybe your pictures, again, got burned, but maybe you have friends, relatives, or something that may have pictures. Maybe there's somebody that you know in the immediate neighborhood who either recently moved in or refinanced that you're aware of, and that would have required an appraisal, and you can contact that appraiser. Maybe that appraiser has some information that he can use relative to your property, even though maybe he even has pictures of your property, for all you know. I had a situation where people had bought a house and they had not done anything to it, and 2 years later the house burned down in a fire back in 2008. Well, we went back to the appraiser who appraised the house originally. He had all of his documentation. They hadn't made any changes to the house, so he basically updated his appraisal for what it would be. And originally they bought it for $2 million, but in the market decrease at the time, it had gone down to $1,800,000. So that was our value before the event. Value after, okay, depends upon a number of things. Maybe there was partial damage. Maybe there was, and that one is probably the toughest, where 40% of the house burned down, but 60% of it's still there. That's going to be a little bit of a challenge for the appraiser, but remember, they take a lot of training. They should be able to do this. Okay, let's take the case, what I call the simple case. The house has completely burned down. It's gone. All we've got is ash. Okay. So, simple way for the appraiser, a simple example for the way the appraiser could accomplish this is the appraiser could look and say, geez, you know, before the fire, there was a lot that looks to me to be reasonably similar to your property in, I'm going to make it simple, in all of its characteristics, size, shape, views, whatever, trees and whatever. It turns out just sold 3 months before the fire. And that lot sold for $300,000. So, looks like your lot might be worth $300,000 after the fire. Wait, hold on. My lot has debris on it immediately after the fire. I may have cleared it off, spent a lot of money to clear it off, but right after the fire was all that debris. At that point in time, that debris has a negative impact on the value of the property and needs to be taken into consideration. How the appraiser does that is his professional judgment. But some of the ways that he might do it is you might say, geez, Henry, here's the cost. I spent $20,000 to clear the lot. He says, oh, okay, that's information. And then he might look and say, you know what? I think in my professional judgment that the difference between pristine and debris is 10%. So rather than $300,000, I think it's worth $270,000. However he comes up with it, as long as he knows what he's doing, that's his judgment, okay? But there's another little important piece. I have not been to Black Forest. Again, when I think about I'm thinking about, I'm kind of getting flashbacks of Northridge, okay? A lot of damage, a lot of destruction. Does anybody want to come in and buy even a house that wasn't damaged at this point? Your neighborhood is depressed in value just because of the stigma that is attached to it right now. My mother-in-law's house, we helped her sell her house in 1992, 21 years after a 1971 earthquake. We were told by the real estate broker, this particular area suffered a lot of damage in the 71 earthquake. Make sure that it doesn't exhibit any evidence of damage from that earthquake. Now, my father-in-law spent a lot of money fixing the house up after the earthquake, so we didn't have to worry about that. But it was interesting that 21 years later, there was still a stigma on that neighborhood. Now, it sold at, I think, at a reasonable price, so we were okay. But this is a situation that does arise. The IRS's position is, yes, there is going to be a depression in the market due to buyer resistance right after the event, but that's temporary, and you have to ignore it in your post-event valuation. So that cannot be taken into consideration. There is one case, Finkbonner, in the tax court. It's the only case that anybody's ever been able to find where a taxpayer was able to show permanent buyer resistance. I got to tell you, you're not going to be able to satisfy 10% of the requirements, and even after they did satisfy all of those things, they got a really small amount for buyer's resistance, so it really wasn't very useful. Buyer resistance. Buyer resistance. Right. This is, right now, who's coming to buy your properties? The vulture buyers, right? That are looking for fire sales, right? Okay. So the appraisal needs, the post-event appraisal needs to identify for your benefit that they have taken into consideration the presence of the debris. They don't have to specify, well, we took 10% off. They just have to note that they acknowledge that there was debris and that they considered it. But they also need to acknowledge that their valuation does not include additional reduction due to temporary buyer resistance. Okay. What's an appraiser? I think last night I spent 15 minutes in questions on what an appraisal or appraiser, who qualifies. Make it real simple. And I know there's all kinds of places where you can get valuations, and I'm not even going to put ideas in your head that are not already there. This is what an appraiser is. To make it simple, when you go to refinance your house, when you go to buy your house and you say, Mr. Lender, I want you to loan me the money to buy this house, the lender says, we need an appraisal, we will get an appraiser to come out and appraise the property. That's an appraiser. It's a professional, probably, I don't know what the rules are in Colorado, California, they have to be licensed as appraisers. Those are the people that you need. And for real property, that's going to be a requirement for this method. Absolutely. Okay? What needs to be appraised? Well, for real property, that needs to be appraised. Not yet. If you're taking a picture, I don't know, whatever. I have bad eyesight. What needs to be appraised? Well, for real estate, we've already gone through that. You need an appraiser. But what about the other stuff? All the stuff in the house. There are no hard and fast rules on this. What I can tell you is that in another section of the code dealing with charitable deductions, and maybe some of you are aware of this, maybe not, but if you give stuff away, an item of stuff, goods, to a charity, not money, but goods, that has a value of $5,000 or more, you must get an appraisal. So I take that information and I come back over here to my casualty loss and I say, well, I feel pretty confident that any item that had a value before the loss that was less than $5,000, I don't need to worry about an appraisal. That doesn't mean I don't need to find out what its value is, but I don't have to hire somebody to do it for me. I can go out and accomplish it myself in some manner. And this gets tricky, okay? Because let's take that couch in your living room. Let's say that you bought the couch for $3,000, okay? Well, you bought it 2 years ago, 5 years ago, 10 years ago. Do you think it's still worth $3,000? I don't think so, okay? Maybe it's worth, it still has as much value, usage to you today as it did when you bought it, but it's no longer worth $3,000, okay? You might try looking at not necessarily high, not specifically high-end, but maybe used furniture stores that you say, geez, there is a couch that looks like ours, pretty much, and God, it's sitting, it's about the condition ours was. Well, that might be a guide, and maybe not, where you look and say, geez, it's got a lot of stains on it. Ours didn't have. My mother's couch that she bought in 1948 when she died in 2008, never let me sit on it. So it looked the same as in 1948, but it still wasn't worth as much. As a matter of fact, Goodwill, or the high-end charity that I tried to get to take it, looked at it and says, no, we don't want it. It's great condition, but we don't want it. So we've got to go through and make reasonable estimates. Where you can go. Here's an example. Let's say you've got a lot of books. And let's say you can reconstruct that you had, let's say all the shelves in your bookcase were packed with books, and let's say you go back and you say, geez, there was about 30 lineal feet of books, okay? Well, if you go to, say, Barnes & Noble or some bookstore, that maybe you could convince them to allow you to take selections of different books off the shelf and come up with a stack, maybe, say, 6 feet tall, 1/5 of your 30 feet. And you stack that up 5 feet. And then you go through and you come up with the prices of all those books. So you've been random, but of the similar type of books that you have in your house, that might be a basis for claiming the replacement cost with your insurance company. But these are new books, so that's probably not the value of those books. But there are used bookstores. So you can go and look and say, geez, here's a row of books that in general looks like our books. And so you take your measuring tape and you measure off 5 feet, and then you go through and you add up the prices of those. That would be probably a fairly reasonable basis for coming up with the value of the books before the fire. That would be one way that I think, you document how you did that. I think you'd be okay with that. Because you made an effort. You did something, and it's reasonable, okay? So there's other things you can do. There may be, I don't know if the library has old catalogs, like old, I don't know, I don't think Sears does a catalog anymore, but in the old days you could get like an old Sears catalog or something at the library. You could find out, now maybe you didn't buy it at Sears, you bought it at a higher end store, but that would be a starting place, okay? So different ways that you can go about doing this. It's going to take some time. Don't get stuck in the minutia of the utensils in the kitchen drawer, though, okay? Be reasonable. Don't drive yourself crazy on this. So that's what can be, what can be, and if you had something really expensive, maybe there was a piece of artwork or a piece of antique. Well, there are people that do appraisals of antiques. There are also a lot of books out there that are published on values of antiques, and you might be able to go through. One, you might be able to find exactly your antique because maybe there are 100 of them that were built. Or maybe you find things that, geez, this is a category that's kind of the same as ours. And that's a place to start in terms of the value. Now, that may be more or less than your cost basis. So we can't ignore the cost basis, but we're talking about the value before here, okay? Now, one place that you don't want to, I'm not saying you should never use, but let me just tell you that when the IRS brings somebody into court from Salvation Army, and I'm not picking on Salvation Army, it just seems that that's the organization that they bring people in when I read the tax court cases. And the guy gets up there on the stands and says, well, I think Barbara's couch was probably worth $500 because we have one in the store that I think is exactly like hers. The judge says, have you ever seen Barbara's couch? I don't think so. Are you an appraiser? No. Out. Okay? The IRS loses on that. So if you're in an audit and the examiner says, we're going to go down to the Salvation Army store, you say, no, we're not. Not going to happen. Okay? The other thing is, let's think about the purpose of the Salvation Army store. They are taking donations which they want to convert into cash to use for other things, right? So they're not necessarily selling things at, quote, fair market value. They're selling things to move them through the store so they can bring stuff from the warehouse and move more stuff through the store, right? So that's not any indication of fair market value. Okay. Let's talk about the house now. Another aspect of the house. And this is really important. Let's say that, take an example, your house was not touched by the fire at all, but in the back of your property there were these magnificent old growth trees that were totally burnt. So you think, well, geez, what do I value? My loss was those trees in the backyard. And I remember back in the 2008 fire up in Santa Barbara, and I don't know if these type of people are here, there was a guy that was going around and saying, I will appraise the trees that you lost. I will get information from Google Maps, and I will get the tree before and the tree afterwards, and I will identify the trees because I'm an arborist and all this stuff, okay? One thing that person does not have as qualifications, he's not an appraiser, okay? That's the first problem. Second problem, when it comes to personal use real estate, your personal residence, your primary residence, any second home or vacation home, all of those general classification of personal use real estate, what is required is valuing the whole property, the structure of the land, the landscaping, the trees, whatever, the whole thing, not the contents, not the vehicles, but everything else that would be part of what, if you were to sell the property, what would be included in that sale, okay? All of that needs to be valued by an appraiser before and after, not pieces. Now, having said that, if the appraiser wants to go out and hire that arborist to come up with some information, that's his professional judgment. Not going to argue with it, because he's the one that's on the hook for the appraisal in total, okay? Okay, let's move on to the cost of repairs. First, it is not, repeat, it is not the estimated cost of repairs. It is the cost of repairs, meaning you have to complete the repairs in order to compute the loss. So maybe you're just getting started in the repair process. Maybe you don't complete the repairs until 2015. And you want to use this method for whatever reason. You're not going to be able to deduct the loss on a 2013 return, much less some other features that I'll talk about later. Your loss is a 2013 loss, but it's deductible in the year that it is a closed transaction. So this is the other side of that closed transaction where you're talking about cost of repairs method. When did you tie down the cost of repairs? So that's one part. Next part. I'm being hooked here. How much time do I have left?
7:25.
Okay, thank you. Okay, I got you. Okay. I got to talk faster. But here's some other additional problems with this. And I've got stop signs and things. But here's some additional problems. You got some code upgrades. Now the county wants you to put a tin roof on instead of the shakes, okay? That is a code, one, it's a code upgrade. For tax purposes, that is considered an improvement. The only costs that you can use are the costs that you spend that get you back to what was there before, and they cannot be excessive, okay? So let's take a couple of inside examples. Your living room was painted, and now you decide you're going to put wallpaper up. Well, for tax purposes, you can't include the wallpaper. For tax purposes, you have unpainted walls in your living room. Kitchen, you had ceramic tile, and you say, you know, while we're doing this, we might as well spend twice as much and get granite. So we'll take 50% of the granite, and that's the same as with the ceramic tile. No, you didn't put ceramic tile in, you don't get to count the granite, okay? So for tax purposes, your kitchen counters have no counters on them. It gets nasty, and it gets very detailed. I'm actually working with somebody, and this happens to be a 2010 fire, 4-mile fire, that I'm working with these people, and they will have a tax deduction on their 2013 return, and we've spent hours and hours sifting through all this stuff. Luckily, the guy is compulsive, obsessive, and actually is able to answer my questions. Now, remember that form, loss, or the value of the property before the loss. Haven't talked about that with the cost of repairs, right? Still have to deal with that. So I still need an appraisal. If I'm going to get the appraisal before, why not get the appraisal afterwards and be done with it? Okay? Because it's going to be a lot simpler. Now, what I have seen in tax court cases and other situations, the cost of repairs method usually comes up with a lower value than the appraisal method. That doesn't mean that one is better than the other or that the appraiser is cheating. They're both done correctly. And there is nothing in the code, and the tax courts, the judges acknowledge that there is no reason why the methods should come up with the same amount. It's not logical that they should. And when the IRS says, use the appraisal method, and because it's 3 years later, we know what the costs are, and they're much lower, and the judge says, and your point is? Okay? So let's summarize that 4684. So we'll talk about different uses of the various columns, but once we come up with groups of assets, so let's say like contents, and we may have multiple columns that we'll see for contents, but once we decide we have a loss overall for the contents, then we have to put all of the content. We can't pick out and say, geez, you know, the women's clothes we're taking a loss on, but the men's clothes we got a lot of insurance value, and so we're going to take that and treat it as an involuntary conversion. No, you can't do that. Okay, but you could have the loss on the contents, but have a gain on the structure, and take the involuntary conversion, not pay taxes, delay the tax, defer the tax on the structure, and take the tax deduction on all of the contents. So first is there may be gains and losses mixed in there, and they all have to get netted. Oops. There are a couple of adjustments, and this is that bottom third of, oops, this is the bottom third of the form. There are two adjustments. One is $100 per event. So it's $100 per event, not $100 per column. Okay? So right off the bat, $100 of your loss, poof, gone. Let's go back and look at page 1 of your tax return. You've got all kinds of income on there: salaries, wages, salaries, dividends, interest, capital gains, farm income, business income, rental property, maybe some pensions, taxable Social Security, then maybe some deductions for like an IRA deduction or something like that. And you come down to a number on the bottom of page 1, and that number is called adjusted gross income. 10% of that number goes over on the 4684 and reduces your loss. So the more income you have, the greater the 10% adjustment is going to be. Okay? So if you've got a large income and a small loss, you technically could wipe out the loss and not have a deductible loss. Oops. The other thing is, now you have a loss on the bottom of the 4684. That gets carried to the Schedule A, where you deduct your property taxes, your medical expenses, your interest on your house, your charitable deductions. Same schedule. There's probably never noticed on that schedule, but there's this little line on there that says casualty losses, and that's where that number ends up floating to. Now, this could end up with a really big Schedule A deductions. That gets carried forward to page 2 of your tax return, and you might generate a loss. Now, it gets intricate, and even though there's a loss there, you may not have what's called an net operating loss, or you may have what's called a net operating loss after you do some complex calculations. And if you're using software, thank God the computer does it for you. And this is excess losses for that year that you can apply to some other year. If you do nothing, then you make effectively a deduction, an election to deduct that retroactively on prior returns. Now, the normal carryback provision when you have a net operating loss, maybe like from business losses or something, is you carry it back 2 years. For casualty losses, you go back 3 years. So the casualty loss for a 2013 return, the excess net operating loss would go back to 2010. If there's anything left over, then it would go to 2011, then to 2012, and if there's still loss, it would go to 2014 and forward. Or you can make an election to forego the carryback and just carry it forward to 2014. But you have to make a positive election to do that. Sorry. Okay, I think I covered everything there. So this is the schedule that's in your handout on the bottom of the second page. Well, the bottom of the second piece of paper. Let me specify that if you have good coverage for your contents and you come out okay on the contents, my experience looking at tax returns, working with taxpayers, it is, in that situation, it is tough to have a loss on the contents. Because you got that couch, as an example, that you paid $3,000 for, but now it costs $4,000 to replace it, maybe let's say $5,000 even to replace it, and the insurance company says, well, we'll give you a check for $4,000 today, and if you actually go out and buy it, we'll give you the other $1,000. Well, even the $4,000 is more than what you paid for it, and the value before is even less than the $3,000, so you probably don't have a loss. And I think in most cases, again, if you've got decent insurance and you've been able to do a good negotiation job, you probably are not going to have a loss. But let's see, maybe there's a loss. IRS has a publication, 584, and it's full of worksheets. And you're not going to use those worksheets. In fact, the sheet that I have behind here is one possibility of how you might go about doing that. And the bottom row of the bottom part is actually tacked on to the right-hand section, so it's a continuation. So I've just split it up in order to not make it so small on the screen and on the piece of paper. I'm not going to step through all of the minutia calculations, but I've tried to make this simple to make a point. I've got two assets here, two categories of assets. One is a piece of jewelry, and the other is 4 men's suits. I go through and do all of the calculations correctly, and I come up with a $120 loss. Okay? Now, it's not so important as to the small amount, but it's just stay with me that it's $120. Okay? If I fill out the 4684 using the numbers of the totals of those columns, and I transfer those appropriate totals to the 4684 as one item, one category, I have no loss. It's just the way the math worked out. I grant I contrived the situation, but the math is correct. Okay? I contrived it so that it would come out with the situation. Okay? But if I make it 2 categories, which we'll see that jewelry is different enough from men's suits that I can legally, it's reasonable to make them 2 separate categories, I can get my $120 loss. Okay? So it's important to think about this. Now, looking at and again, when we get to the disasters, if you're in a gain situation, not a loss, it's going to get a lot simpler. But here's the list that is in that 584. The white ones at the top are all rooms, so you're going to sit down with, you're going to think about the living room. I got a couch, I got a coffee table, I got a side chair, whatever, lamps and stuff like that. Kitchen, okay, I've got dishes, I've got utensils, I've got pots and pans, whatever, okay? So you're going to do room by room. Then below, there's other things that are not necessarily geographically located in the house. Maybe sporting equipment, maybe electronics, things that are on the bottom section on the left side. On the items in the yellow section, you don't have to worry about them, but they're not in the 584, and I point them out because they're kind of common things. I mean, I have some of those, computer cameras, other items that I have in my house that are not listed in that 584. You may have other things. Just, think about what you've got, and you don't have to force yourself just to those categories in the 584. Okay. Okay, so let's move on to a gain. So I think I've said it already, but I'll say it one more. Why do you have a gain? You have a gain because the proceeds are greater than the cost basis of the property lost. Not greater than the replacement, but the original cost basis. So we have a gain. Going back to our bar chart, cost basis, we have insurance, and in this bar chart, I want to be specific because I'm using it for a specific purpose. There's the general purpose, but I'm going to bring in some specifics regarding your primary personal residence, not a second home, not a vacation home, but a primary personal residence. So we've got insurance proceeds that are greater than the cost basis. That leaves us with a gain. Okay? Now, if you were to sell your house, forgetting the fire, if you were to sell your house in the normal course and you had a gain on it, there's a provision that says you can exclude up to $250,000 Married couple, $500,000 if you've satisfied 3 conditions. If you haven't used the rule for at least 2 taxable years, if you have owned the home for at least 2 years at the time of the event, the sale or whatever, and if you have lived in it as your primary personal residence for at least 2 out of the last 5 years. And that 2 out of the last 5 years does not have to be contiguous. It basically has to be at minimum some segments that add up to 730 days, 2 times 365, okay? So if you've satisfied that, you get to use that exclusion. So a form of that exclusion comes into play in this situation where we have a gain due to the insurance proceeds being greater than the cost basis of the house. I'll explain that a little bit, but let's see how that mathematically or graphically applies here. So what happens is that gain, or that gain exclusion, comes off of the gain and also comes off of the insurance proceeds. Zip, gone. It gets disclosed in the tax return, but it magically disappears. So now we repair the property. The first dollars that are spent go to replace the cost basis that we absorbed by the insurance proceeds. The next proceeds go to absorb the gain that remains that we have to deal with. So if you only spend so much that you only replace the original cost base and you don't spend enough to absorb the gain, you're going to have taxable income. The third piece, because you're probably going to spend more than the insurance proceeds, or you're going to take that money that you got for the savings, the gain exclusion, you're going to put that back into the house. That's going to create new cost basis. The gain exclusion. So I've basically given you the basic rules on the gain exclusion, but now need to talk about the special rules that come into play in these situations. So the first one is that in the code section that this is described, it says in order to use this exclusion in these circumstances, the property has to be completely destroyed, or the words actually in the code are there has to be complete destruction of the property. Now, that doesn't mean that the land is gone, but conceptually, we've got a pile of rubble. There's just ash that's left, okay? That makes it easy. That's complete destruction. But the IRS has gone a little further, and they've specified, for instance, if in order to repair the property, the remaining property needs to be dismantled. And they don't say demolished, they say dismantled. So that's a broader concept than demolished, okay? Then you can use this. The other is that if due to the cost to repair the property, if those costs are so great as to be economically not feasible, like in my case, cost of repairing my house was $799,000. The house before the earthquake was only worth $400,000. I think that's pretty not feasible, okay? Even though theoretically I could have repaired the house, okay? This provision wasn't there, so it didn't matter, but I'm using that as an example. So that's that side of it in terms of the restrictions that may limit your ability to use the provision. But now there's one other piece that is a benefit, the side of benefit, and that's that bugaboo 2-year rule, okay? Well, maybe you bought the house 18 months exactly before the fire. So, John, does that mean I can't use the rule because of the 2 years? No. There's another provision that says unforeseen circumstance. I think this is an unforeseen circumstance, okay? So you lived in the house for 18 months out of 2 years. Mathematically, that's 75%. So husband and wife, married couple, need to stop saying husband and wife, married couple. Married couple, 75% of $500,000 is $375,000. If the gain is only $300,000, well, the $375,000 covers it. There's no gain to deal with. If the gain is $400,000, then the 375 only covers a portion of it, and there's still $25,000 that needs to be dealt with. We'll have to discuss what to do with that, okay? So let's talk about what to do with the remaining gain. We have three options. One option is to just report it on that 4684 to line 4, that $24,000 in the last column. Just let it float in there. It either offsets other losses or we pay taxes on it. You're done, okay? Or you say, you know what? Even the money that I would otherwise pay on that $24,000 or $25,000, I need every cent. So I'm going to defer, and I'm going to put that money back into the house, and I'm going to defer the gain. Other possibility is maybe you've got a big gain, and maybe you had a 5-bedroom house, and you say, you know, the kids have moved out. We don't need a 5-bedroom house. We're only going to build a 3-bedroom house. So you don't put all the money back in, and since and you don't spend all of the funds. So the first funds that you don't spend are those gain funds. So now you've got some and maybe part of that you put it back in and part of it you didn't. So part of it gets taxed, part of it gets deferred. Of course, then the third possibility is deferring. Again, this is not a decision that should be taken lightly. You need to look at all of the aspects and the responsibilities attendant to it. The first thing is that you need to understand what's going to be required of you once you make that decision. And there's a whole bunch of, and hopefully you can't read that. I made it small enough, hopefully the people couldn't. Last night the screen was gigantic, and I think the people in the first row could. But in this handout at the end of the evening, after item number 9 is listed all of this stuff. This is the information that has to be put on every tax return for every year during the replacement period. And I'm being given the hook again. So that's part of that decision. Can you go through that? Maybe the cost, because that's going to stuff that you've got to deal with your tax professional. He's going to charge you to do that disclosure. That's going to cost extra. And maybe the trade-off is, you know, I'm just going to pay the tax. Replacement. Just real quickly, what you started out with is what you have to end up if you're using this. So if you started out with a primary residence, it doesn't matter. You know, this is a picture of a house, but I don't know what that house is. I started out with a personal use asset, personal use real estate. It could be any personal use real estate. It's not rental property. If I rebuild and I rent it out, I did not replace my house. I created a new rental property. If I started out with rental property over here and I rebuild and I decide I want to move into it, well, I haven't replaced the rental property. I've created new personal use real estate. They don't work. That doesn't work. The standard is that it must be similar or related in service or use to the original converted property. The test, I've got 80 pages in a book that goes into the minutia, but it boils down, especially it makes it simple in these cases, it's a functional test. Did it function as a personal use real estate? Then that's what you need to end up with. Okay, buy or sell and rebuild or rebuild. Buy and sell or rebuild. Here are the tax implications of that. Let's say, first of all, the issue is in order to take advantage of the tax possibilities here, we have to be in a situation where it's not feasible to repair. So if all you lost was a bedroom or all you lost were the trees in the backyard, it's feasible there technically to repair, and this would not work. But at the other end of the extreme, where all you've got is ash left over, pretty much not feasible to repair because there's nothing to repair. So let's look at the possibilities here. We start out with insurance proceeds of $700,000. We have cost basis of the property of $400,000. We've got a gain of $300,000. The same rules that we were applying at the gain exclusion pretty much apply here. Not feasible, but we also get to use that exclusion, so we use $300,000 of the $500,000 exclusion, and we're done. But we still got a piece of land there. If we sell that piece of land within a reasonable period of time, maximum probably 2 years from the date of the loss, then it's going to get reported as a transaction in that maybe 2015, but it's part of the original deal here. And so cumulatively, we're going to deal with it. And so we've got $300,000 for the lot. We've got $1 million in total proceeds, $400,000 cost basis, $600,000 gain. We apply $500,000 exclusion. We got $100,000 of gain. That gain we need to deal with. We elect to reinvest. We have to reinvest the $400,000 of cost basis plus the gain. If we reinvest at least $500,000, we've satisfied it. We reinvest $1 million, we're in Fat City, and we've got a cost basis of $900,000. Okay, so but if we don't meet the qualifications or we sell it too late, we may or may not be able to apply the remaining gain exclusion. So we could have 300, because now we've got a lot that's got a zero cost basis. We could have anywhere from $100,000 worth of gain that gets taxed, or maybe as much as $300,000 of gain. Timing, real quick. When you have to reinvest the proceeds, there's time limitations. There are two clocks. The first clock starts at the date of the loss. Back in June, a clock started. Okay, that clock starts to run, and a second clock starts after at the end of the year where you first realize a gain. So in my example here, I've got transaction or event in year 0, some insurance proceeds that come in year 1, and nothing happens, and then finally in year 4, some additional proceeds come in, and after the gain exclusion, I now have a gain. That starts the second clock. For a disaster, I've got 4 more years to complete the replacement. Non-disaster, only 2. Okay? This is the Scrooge and Marley portion of the program. I talk about Scrooge because, remember in A Christmas Carol, Scrooge was visited by the ghosts of past, present, and future, and when he saw what his future looked like, he decided to change his life and amend his ways. And I want to point out that Scrooge was an accountant and became a really cool guy. He had a counting house, you know. Cratchit was his bookkeeper, okay? So anyway, we're going to look at a couple of things that are possibly happened in the future. They haven't happened yet, and I'm kind of warning you so that you can avoid them or whatever. So, first one, I know this is nobody in this room because you're all here, so you're all on the program, so to speak. But, you know, we all have friends, okay? And maybe your friend says, you know, I got a check from the insurance company. They don't issue 1099s. Nobody knows I got this money. I'm not reporting anything. I don't care if I had a gain or a loss. I'm not reporting anything, okay? I need a half hour to discuss all of the bad things that can happen. I don't have a half hour. Just suffice it to say, bad decision. Keep in mind, tell your friend, there's too much advantages, there's too much benefits by using the tax code in these situations. Don't go down this road. Next one. Now you've got this, you're dealing with your insurance company, and let's say that your insurance company is willing to pay you a year's worth of ALE so that you can go out and buy, or not buy, to rent a house. And let's say that based upon your policy, your standard of living, which are all these things that come into play, blah, 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 you're entitled to $5,000 a month. And you tell them, you know, I'm definitely not going to be done in a year. Just give us a check for $60,000 and we'll deal with it. So they say, okay, fine, here's $60,000. And now you're looking at that check for $60,000 and you turn to your spouse and say, We're going to spend this on rent receipts? Whew. There's a house over here that we can buy for $300,000. We can use this money as a down payment or towards the down payment on that house. Good financial decision. Has tax consequences. When you buy an asset, that's not additional living expense, that's an investment. Now, you may be able to deduct the interest in the property taxes, but the purchase is an investment. That $60,000 got spent on an investment. The $60,000 now becomes ordinary taxable income. Still might be worth doing, okay? But you need to be aware of the consequences. Now, here's another step. You've made that decision to do that. Shut up. You've made that decision to do that, and now the question is, how long are you going to live in that house? Okay? So you spent $300,000 on that house, and let's say you're going to spend $900,000 on rebuilding the damaged property, the lost property. And let's say that you got $300,000 of gain that you need to deal with. There's nothing in the tax law that says you have to only buy or have one replacement property. There is nothing. As a matter of fact, in several court cases and even IRS rulings, they discuss possibilities of multiple replacement properties. So we could say, hey, this house that we just bought here for $300,000 is part of our overall replacement. So we got $300,000 here, $900,000 here. That's $1.2 million. This is 25%. That's 75%. $300,000 gain, 25%. $75,000 goes over here. Could be cute. See why in a second. If you live in this house for at least 2 years as your primary residence, and then you sell it, and let's say that you sell it for over $300,000, but not at a gain, probably a couple of years, probably not a gain more than $500,000. You had $75,000 of that gain over here. Poof, $75,000 of gain just disappeared. Okay. But what happens if you only live in there 18 months? And now you move back in here and you rent, decide to hold on to this property and you rent it. Well, okay, so you've got a cost basis of $225,000, maybe okay. But if you go to sell it for $300,000, now you've got $75,000 gain. Probably was a bad decision. So maybe, maybe not, okay? There's always two sides of the coin. 3 questions. God, I sat there and the clock went off 3 times and he still kept talking.
And we haven't gotten to questions. We're almost out of time.
Okay, so I'm going to ask 3 questions. I listened to John. See, I get to ask the questions first. I listened to John and I decide I'm just going to pay the tax. Too much of a problem, too much reporting, record keeping. I'm just going to go ahead and pay the tax. And now you get into the process and you're in 2015 and you've paid the tax in 2014, maybe 2013, depends on when you got the proceeds. But now you decide, you know what, I really need that money to finish construction. You can go back, amend the return, and the government will give you back the money. No interest, but at least they'll give you back the money. No questions. Well, some questions asked, but pretty much no questions asked. It's a pretty easy thing allowed. Second possibility, this goes back to that concept of not a closed transaction. I thought I was done, and then I got more insurance proceeds or some other proceeds that are tantamount to insurance. So let's say in the year that you took the deduction, think of this again as a bar chart with at some level here. In that year, without the casualty loss deduction, my taxable income was here. Casualty loss brought me down to here. I got benefit of the loss at varying lower tax rates as you get closer to 0. Now we come to a future year. Again, your income hasn't really changed, but you get these additional proceeds. Now you have to recover that loss in this year. You don't go back and amend that return. You have to report it in this year. And to the extent that you reported a loss here, those additional proceeds get added on, and you're going to pay taxes back at higher rates. Okay? Expensive interest. I had a case, pretty much retired folks. They had seemed like a fairly large loss. They ended up deducting the loss on their 2007, 8, 9, and 10 returns, 4 years, got a total tax reduction of $20,000 state and federal. 2011, they got a big check on a lawsuit, and as a result of that, they had to go back and recapture those losses. So their income was about the same, okay? Would have been $5,000 of tax to pay that year without this check. But now we have to go back and add each one of those 4 lost years. Their additional tax on that year was $48,000. Benefit 20, payback 48. Bad financial situation. Last one. I listened to John and I said I can do this, and I elected to defer the gain, and now I'm into the process, and I'm not going to, I can't do it. I'm just going to move into an apartment. I'm going to rent, and I want to pay the tax and be done with it. Well, here's the problem. Once you make the election, the code assumes you're going to replace. There's no exit on that. Well, there's one exit. The exit is the 4 years has expired and you haven't done it. Well, now you have a taxable event. But the taxable event was back here when you got the proceeds, not 4 years later. So now you have to go back and amend this return, and you're going to pay 4 years' worth of interest, because the IRS does charge interest on that. Presently, the rate is, I don't know, about 3% a year. So you're looking at, and the rate's probably going to go up in the future, so you're looking at something greater than 12% penalty in the form of interest. But there are no penalties for underpayment. That's the good news. Okay, we're almost done. We're federal disasters, okay? There's some reporting exclusions, delays, and stuff that were allowed because of the federal disaster declaration. Those are pretty much, I think, gone by the boards by now. The only reason why I leave this slide in here for this purpose is it does not affect, never did, never does affect your responsibility to continually file tax returns. Just because you've experienced a disaster does not give you a holiday for filing tax returns. I say this because I've seen it too many times, so I just want to warn you about that. Now, you may have an extension, files return of April 15th, you may get an extension to October 15th, but you still got to file that 2013 return, and then your 2004, just in normal course, okay? Losses. Here's a special rule. Special rule only for disasters. Got one-time offer. You have a choice. If you have gotten all of your documentation closed up, pinned down, closed transaction, appraisals in place, insurance known, you have the choice, if you have a loss, to deduct the loss on your 2013 return as usual, or file an amended return and essentially pretend by deducting it on the 2012. It'll still get reported as a $2013 disaster loss, but it gets reported on your 2012 return. That may be beneficial. Maybe your tax rates were higher, but remember, if your tax rates are higher, probably your adjusted gross income is going to be higher, so there's going to be a bigger adjustment. A lot of stuff goes into play here. The other thing, or maybe your 2012 is zero income, so you don't have any 10% adjusted gross income adjustment to make, and therefore you're going to get a bigger benefit because you're then going to carry it forward to 2013. That's a possibility. A lot of stuff goes into this. You're looking at 4 or 5 years to come up with the value of doing it one way or the other. So you need to think about that and talk to somebody and work through the numbers. I wasn't sure. I don't think any orders to demolish, have there been issued? Okay. Just one? We're past the time. If an order to demolish is issued at this point in time, that is a new casualty loss. It's a new event. You go through the whole process again. You got a new 10% adjusted gross income adjustment. Okay, gains. Two things on gains. First of all, well, a couple of things on gains. First of all, there are two special provisions relating to gains. One applies to the primary residence, not all the personal use, just the primary residence. The other one applies to investment and commercial property. We're not going to discuss that one. So I'm not talking about ag property or businesses or rental property. I'm just talking about the primary personal residence. Two aspects, or several aspects. The first important aspect is the contents, okay? The contents money. As I've been trying to get across, if you get contents and you say, you know what, I don't know if I got a gain or a loss, I don't want to go through the computations. I got the money from the insurance. It's a lot of minutia. And now I got to go back and do this all for tax. In disasters, contents money you can totally ignore. You can take that money, mentally put it in a box, put it aside. It's done. Okay? Closed information, done. If you have a loss, you're entitled to take the loss. But if you decide, I don't know, or I think I have a gain, put the money in a box, put it aside. Conceptually, I want you to mentally put it away, okay? Because otherwise you're going to get confused with what I say next. But that contents is not scheduled property. It's only the regular contents, the non-scheduled property. Now, what do I got left? Well, I've got funds from the scheduled property, and I've got funds from the real estate, okay? Primary residence. And I've got a gain. I take all of those funds, and I put them net of that gain exclusion. I take that out of the mix, and that is one common fund of money. The importance here is how I spend that. So let's say that I had, what are my numbers here? $1 million for the house, and I had a $500,000 exclusion, so I've got $600,000 remaining, $500,000 remaining, plus $100,000 for scheduled property. So I've got $600,000 that I've got to deal with. I've got some gain. I don't care what the gain is right now, but I got $600,000 that I've got to reinvest. I can reinvest it in any combination of these items. Real estate, personal use. It doesn't have to be even the primary home, just as long as it's personal use real estate. Scheduled property, if I want, and contents. So I theoretically could take my $600,000 and go out and buy a piece of artwork, move into an apartment, put that $600,000 piece of artwork on the wall. I'm done. Okay? But let's take an example here. That $600,000, I spend $360 on the house. I spend $120 on scheduled property and $120 on contents. Let's say that I had, what's my number? $100,000 gain, 1/6, okay? So 1/6 of all of my dollars here is going to be gain that gets allocated. So the $120,000 that I spend on contents, I'm going to have $20,000 of gain that's going to get allocated to contents out of that $100,000. Well, what's going to happen to that contents? You bought $120,000 of couches and clothes and TVs and stuff. You can ever sell that stuff? I don't think so. It's all going to wear out. That $20,000 disappears, never to be taxed, okay? Totally legal. Okay, we are there. Don't forget the April 15th deadline, but don't rush to deduct. Look at that schedule, things that are important today. And last but not least, personal experience. You're angry, confused, vulnerable. That's what happens after these events. That's normal. You've been subjected to tremendous pressure, stress, and you're in psychological shock. I guarantee it. I know it because I lived it, okay? The most important asset you have is your personal resilience. Don't let those people out there, they are expert at doing it. Don't let them take away your stamina, your personal resilience. And with that, we have time for questions.
So we have about
2 minutes.
10 minutes total for questions. So what I want to ask you guys to do is, if you have a question, line up in the aisle, and then we'll get to as many as we possibly can. And then, John, did you want to say something about the website?
Yeah, as you're doing that, as you're getting there, I'm going to go forward a little bit here. First,
this is good. Yeah,
I'm going to thank you for coming out tonight, and I wish you the best in terms of stop. That's okay. Thank you. Best. I wish you the best in terms of your successful recovery. I have a website, I have a telephone number, and most important at this point in the evening, my website is www.trapanicpa.com. If you go to that website, that's great. But there's a hidden page, okay? If you put in your browser www.trapanicpa.com/process, you will go to a hidden page, and there will be a question, a series of questions, statistical information.
John, I'm going to interrupt you for 1 second, because we will have that link on the UP website.
Yes, there will also be on the UP
So we'll
website.
put that so you can get to it from there, because people are leaving, and I
Right.
want them to get it. Also, make sure that you grab one of the handouts. It's a separate handout on the way out, too.
And if you have questions
Okay,
that
and
you
we're
want
going
me
to
to
do
contact
questions,
you,
because
fill out
now
this.
we have like 7 minutes.
Okay.
I have two questions. One is, what type of qualifications should we look for in a CPA that we're using to prepare our tax return? Are there courses they should have, or a degree?
This is a tough thing. The only I think I still have my
okay.
card. Let me just talk in generalities, okay? Because I don't know. I am actually working with a CPA on that 2010. I'm actually consulting with him, so he's hired me to help his client, okay? But let me specify that the handbook that most accountants, if they have, even buy the handbook, is 1,000 pages in length. The stuff that I've been talking about tonight is 20 pages at most, okay? Not a big piece in there, but a big consequence.
But how do you find somebody?
I can't answer that. You want my card? I'll give you my card, but that's all I... Yeah.
And my other question was, how do you do a cost basis on things you inherit?
Inherit. Inherit is what the property was valued at the date of death of the person who died. If there was a 706 that was filed, then it's in the 706. Sometimes the 706, a lot of times, is not even required, but you got to maybe find out whoever was executor of the estate should have gotten an appraisal on the property, and that would be the cost basis. Let's go over to the side.
Hi, Mike. Thank you. My question is, I owned a vehicle.
Okay?
It only had liability insurance.
Okay? No collision, yeah.
Just liability insurance. So it was, as
No-
far as the
no
insurance
proceeds.
company, it was like the
No
first thing they
proceeds.
did.
Right.
What is the cost basis? The sticker price when I bought
No,
it,
what
or
you-
what I
what you-
financed it for?
No, not
How
what,
many payments
because
and-
you made a down payment and you got a loan, right?
Correct.
So if the car had a sticker price of $25,000, but you beat them up and you got it for $23,000.
No, let's talk. It was the sticker price was $10,000,
Okay.
and I
But-
ended up paying probably $17 by the time I was done with payments.
Well, but part of that was interest.
Correct.
Okay. The interest is irrelevant.
So the $10,000 is a cost basis.
Plus any plus the down payment.
Okay.
Okay.
I think that answers my question.
And that's your cost basis. Next one over here.
We had our insurance company do a listing of our personal property, value the property. Can we use that for the
Yes.
cost basis?
No. Okay. That was easy.
You can use the list.
To help you reconstruct. That's that schedule in the handout. Okay.
Yes. How do I document my cost basis for improvements over 35 years?
Carefully.
You know, I have no
Okay,
documentation left.
okay. What I would suggest there is get together with the family and have a meeting and say, okay, we've worked on this house for 35 years. What did we do in segments? What did we do for the first 5 years? What did we do? And just make a list.
Well, I can do that, but
Okay.
what is the IRS going to accept
Well,
for
again-
documentation?
If you're really detailed and you've got substantiation, maybe plans that you can get from the county.
There are no plans. The county has no plans for my home for 35 years ago.
Okay, you may be in trouble. The problem is that somebody's going to look at the reasonableness. What I'm saying is that if there's plans or there's permits at the county, that's a starting place. If for some reason you were able to build without plans and stuff, then you got problems, and I don't know. You've got to sit down and come up with as much detail as you can. Find out if there's people who took pictures at your house. Get those pictures. They may be a picture of Aunt May, but it may show.
Well, they have pictures, but that doesn't show a bathroom remodel, a kitchen remodel, all that stuff.
Well, yeah, I assume people don't take pictures of people in bathrooms, but maybe there was pictures in the kitchen, and maybe there was pictures before the remodel and after the remodel. Okay. I mean, it's difficult.
Well, you do the best
it's
you
difficult,
can.
but don't give up. Don't give
you
up.
do the best you
Do
can.
the best you can.
And be logical and fair.
Don't be greedy, but don't wipe yourself out either.
Okay, so you're supposed to keep your tax records for several years.
Actually, your
Previous
tax
years.
return you should keep forever. That's first thing. But anyway.
Not
but,
anymore. It's all gone.
Well, okay.
So-
Well, there may be ways to get it. I mean, I produce PDFs of my clients, and you might call your tax preparer, and they may have copies or be able to regenerate them. Or the IRS, at least for the last 3 years, can give you regenerate a copy of your return.
Okay, I kept all my records
Okay,
myself. So
okay.
every last receipt, everything is gone.
Gone.
Now, in theory, they could come back and audit me for 2012.
Right.
What do they do in that kind of case? If I have absolutely nothing to
You ever hear of
in-
George M. Cohan?
No.
He was a song and dance man in the 20s and 30s. He was screwed by, pardon my language for those listening in the video, he was stolen from by his manager, records all gone, IRS attacked him, he went into court, he made a presentation, the judge looked at him and said, some of this is reasonable and I accept it, and gave him credit. Now, it's not 100%, but there's a reasonability that comes into play, and you can always, if somebody's arguing, say, let's talk about the Cohan rule. Okay? That's the best I can tell you in 30 seconds. Okay.
I have a question. You were
Yes,
talking about cost basis. Lots of people in Black Forest, we owned our home for 35 years. Our cost basis is very low. And it's really scary because it's not really actual value. It'd be like, our cost basis.
Yeah, it's not value. It's cost basis.
Yeah, our cost basis in 78 was, say, $60,000. It seems so unfair that if I...
You can never deduct, you can never have a loss greater than what your investment is. Okay? My house was...
But not the replacement cost.
No, that's
But
not what you're...
it's not
that's not
replacement
what,
cost. It's different than insurance. It's a totally different story for a different reason.
We can have hundreds of thousands of dollars of loss, and we still could...
You're talking, you take the basis, you take what you pay.
Remember,
and what you
okay.
add in.
Remember
It's
that
just
for,
used to confuse
when we're
it.
dealing with the tax here, we're trying to mitigate your situation, not take care of it. We're trying, basically the law is there to, intention is to try to stay out of your hair and where possible provide some help, but it's not one replacement for insurance. So if your cost basis is $60,000 and you got $300,000 from the insurance company and it's going to cost you $500,000 to rebuild, well, first of all, $300,000 versus 60, you got a $240,000 gain. Husband and wife, no, you use the exclusion, so you're out of the box on that, no gain, okay? But you need to report it, and then you move on and you do the best you
So the
can.
gain then becomes like if you had sold it.
Right,
Okay.
right.
I know, it just seems so
I know,
unfair.
I know.
thought I thought, well, if I had sold my house.
Remember,
the year
this is,
before and bought another
it's just a
house-
matter that the IRS is trying to stay out of, you know.
Okay. We need an all-day workshop. That's what we need.
Yes.
You had mentioned that coverage A and B
Get combined.
combine in the
Because
personal, which
residence.
coverage A and B is the principal residence, it could be a guest home, it could
Well,
be
all the stuff that's on,
fencing,
it's all the stuff that's on that
trees,
personal.
everything.
Right.
What about on a rental piece of property?
Okay. Rental, now, first
you
of all,
break it up
well,
into
no, you have to break it up, actually.
Good.
And the other piece on the rental is you probably have records because you've been depreciating it, so that information is in your tax return.
But you're not forced to put it all together.
Fill out one of those green sheets, because there's more to it that is all good news. So fill out one of those green sheets, and I'll contact you, and we can discuss it a little further. Okay?
It's, the impression I got tonight is that we have to have everything ready by April 15th in 2 months.
Not necessarily.
But that's the impression you've given.
Okay.
And we haven't even a chance to get
The
near
only
that.
thing- the only
because
thing
here's
about-
the, listen,
Okay.
hear my whole question
Okay.
out. And as part of that, we still have to, we're still struggling just to get
Right.
our insurance stuff
Sure.
done, let alone
Yeah, okay, I
that.
understand.
Okay,
So you don't
here,
have
let
a
me
clo-
give you some
you don't
examples.
even have a closed transaction.
I have no closed transactions.
Right, okay, so
Okay.
you don't know if you have a gain or a loss.
Don't have any idea.
Right, so-
we do have some estimates that
April
we.
15th is not a date for you.
Okay, let
You-
me ask a couple other qualifying things
Okay.
to help hone this.
Okay, sure.
Oh, no, I
Step
thought,
down one more step, so I'm not.
I forgot. I'm sorry.
Okay, that's okay.
The difficulty we're having is things like, here's an example, because you raised one item that I think has created a problem for me.
Okay.
Because the insurance company was unwilling to manage our rental that we have while we were, because our property was completely, our home was completely
Right.
destroyed.
Okay,
They put a lump sum in our account,
okay.
okay?
And you rented a property?
And we're renting a property
Okay.
and so on. But what you said was that when they gave it to us, that was a taxable.
No. If you took the money and bought property instead of using it for the rent receipts.
So I've got it setting in my checking account.
And you're
we're
using it for
paying our
rent.
rent
And such things that
and
are
things
additional.
that have to be.
Okay. Here's the,
But let me
okay.
clarify. They normally would rent furniture
Okay.
to put in there, and it would
Okay.
come out of that same money.
Okay.
But we have to have furniture. We
Okay.
bought furniture that we'll have so we
Okay.
can transfer over to the house
Okay.
when it's
So
rebuilt.
that's replacement
That-
contents.
Yes, so that's replacement contents.
And if you had a
So
gain-
that comes out of the ALE?
No, it comes out of the contents money. Or it actually could be coming out of your replacement of your structure.
But nobody's-
Because remember I said we can spend that, if we have a gain, we can spend the money on structure or contents.
But when do I have to do that? They gave me that money last year.
Okay?
And I
You need
haven't
to-
even
you
had.
There's a reporting of all those things that I said that are at the end of item number 9. You need to report, start off on the assumption that you're going to have a gain and start reporting those items. I don't know, there's about 10 or 12 items, and start reporting them on your 2013 return as best as you can. You may not have information about some of those things, and you say, information to be reported when we know.
Because I haven't even been
Okay.
able to get an accounting from the
Right.
insurance
Okay.
company what they gave me this money for. They
Okay.
don't give me a check even. They transfer it into a checking account. It's
Okay.
all opaque.
Okay. So let's say with the ALE money, first of all.
Because I don't know
Okay,
which
let's
of
go-
that is the ALE.
Okay.
They just do lump
Well,
sums.
ask them to
I have, and I haven't gotten one.
well,
I haven't gotten an accounting, and I've asked them
the only
over
thing
and over again.
I don't know how to, we're getting to an area that I.
No, but I'm
I
telling you,
haven't
this is
come.
what I'm
I'm
faced
just
with
saying
trying
these
to
are the rules.
document.
Okay.
Yeah.
But since you brought up ALE, let me just say one thing about that I didn't say before. If you are actually spending the money on ALE, and now take the example that you've got where lump sum went into your checking account. So now you've got all this ALE money and you're spending checks, right? Okay. Maybe if you spend all of that money and you even spend more because maybe you run out of funds and you still have to pay rent and whatever, that additional cost is, one, it's not deductible. Okay. But let's say that you're in a great situation where the ALE money, it turns out your house is ready to move back in and there's still $3,000 sitting in that ALE fund. That becomes taxable, but it's taxable in the year that you no longer are incurring ALE expenses. So that might be 2015 or 2016.
Okay, so ALE, if we're unable to, because of the large-scale destruction and the availability of resources to rebuild and other complicating factors, we don't get to get out of the, get the house rebuilt and get into it, and we're in a rental property for an extended period of time, even past what the insurance company was willing to pay for. You're saying that's not a deductible item at all?
That's not a deductible. Matter of fact, up to about 20 years ago, the ALE was actually fully taxable. So it's gotten better. Okay? But the rule is you cannot create a loss with additional living expense. There's no tax deduction for that. That's just the rules. Like, don't shoot the messenger.
And here's a final comment. We should have had an all-day about July, because this is way too late for us to deal with.
Not necessarily.
Yeah, but it likely would have changed how we dealt with some of this stuff.
Okay.
And prepare.
Yeah. Let me go back to that April 15th. So you have to file a return by April 15th, but you don't necessarily. You may not have enough information. The only thing about April 15th is if you have all of your ducks in a line and in order and stuff like that, and you have a loss, then you have the opportunity to make a decision to deduct the loss on your 2013 return or your 2012. That's the only issue of April 15th. You do have a requirement to file a tax return, and the due date of that return is April 15th, but you can get an extension till October 15th. And if you don't have all the information, you say what you know, and maybe you have a settled.
When you say what you know, tell them what over and above your normal stuff.
That list of things in item number 9, you look and you say, here's the information I have cumulatively for this. I don't have a conclusion, but here's the insurance proceeds I've received up to this point in time. And that up to this point in time, you would cut off at December 31st. Of 2013.
I would tell them that. Now, does that affect my tax consequences
for
2013?
It's
informational?
It's just information. It's not, you're not reporting it that it's going to page 1 of your return. It's just you're putting them on notice. Hey, we're out here. We had a loss. I don't know what the results are. Here's all I know. We'll get back to you.
All right. The reason this April 15th was so critical for us was my wife and I worked in 2012, so we had income. My wife had a serious medical problem that I had to now care for her for 2013. So we had basically no working income.
Okay.
So we're not prepared because of all these.
Okay. So
to file
let me
by
cut you
this
off.
April.
Let me cut you off. Let me cut you off real quick here, because this is something I want to apply to your situation. Effectively zero income in 2013. Okay?
There's some, but not.
Well, but very low,
and
you've got your other itemized deductions and stuff. So probably before the casualty loss, you're probably in zero income, zero taxable income,
or low.
maybe or less already. Okay. First of all, because of your very low page 1 adjusted gross income, this might be a good year to claim that if you have a loss, to claim that loss. Now you've got till October 15th to figure that out. And if you come
to claim how much loss?
Well, if you can tie down the loss by October 15th in time to file your return timely with extensions for 2013.
No way on this planet.
Then it's going to be a 2014. It's either going to be a 2014 loss or a 2015 loss.
That doesn't work well at all.
Fill out one of those green sheets, and I'll get in touch with you.
Yeah, he's got fill out a green sheet or go on John has been so
Yes.
So there are questions that can go to him after.
You're very welcome. Thank you.
Yes.
Yeah, okay.
Yes.
I'm going to shut this off.
Yeah, there's a room
Please shut this off.
for-